Thank you so much, Chris. It's a delight to be here. Thanks to everyone in the room and on Zoom. As Chris said, my name is Mark Shepard. This is a paper that's about a topic that you might not be familiar with, but we'll hope to convince you by the end is really important. It's the idea of ordeals, which are hassles to enroll in social programs, but in particular in health insurance, and how you should think about whether they work well in markets like health insurance characterized by adverse selection. We'll call those selection markets. And we'll give you evidence from a health insurance auto-enrollment program that I hope you'll find interesting. This is joint work with my student, Miles Wagner, who just finished the PhD at Harvard, and he's headed to Ohio State as an assistant professor next year. And we're really delighted to be here. I love health policy. I'm a huge fan of applying economics to health policy, and so it's a great pleasure to be here at CAHPR to share my work with you. Okay, a couple motivations for the talk as we get started. There's one policy motivation and one kind of more heavy economics motivation. Start with the policy. I think we're all well aware that persistent uninsurance is a big problem in the United States. We have a goal of getting to universal coverage, at least de facto, in terms of what we're trying to get to. But despite the Affordable Care Act now being 10 years old in terms of its implementation, we're still not there. And there's high and persistent uninsurance in the United States. Here's a graph that shows the uninsurance rates for the whole population. It fell dramatically after the Affordable Care Act was enacted in 2014, but it's kind of been stuck at around 8 to 9% since 2016. And that's about 30 million people who are still uninsured today. It has, the fact that it's not gotten further, right? In a sense, we made progress on uninsurance, but we covered less than 1/3 of the total gap. I think that's not appreciated enough in the policy debate. How do we get this last 8% covered? And you might think, like, when you read the policy debate about what's going on, it's all about people who don't have access to coverage, right? They're in a state that hasn't expanded Medicaid, or they don't have access to subsidies, and the prices are still too high. But when we look in the data, about 2/3 of the uninsured seem to be have income and family statuses that would make them already eligible for pretty generous subsidies. And about half of the uninsured have income and eligibility that would likely make them qualify for free coverage, either via Medicaid or a health insurance exchange. And so the question is, why do we still have so much uninsurance? Why is the bulk of the uninsurance still there, despite affordability in some sense being taken care of for that subset? And so we're going to point to non-price barriers or ordeals to enrolling as a big part of this story. And I think this is a broader part of a broader puzzle within economics and public policy around incomplete take-up of social programs. It's not just health insurance. If you look around different programs, especially for the poor, there's incomplete take-up of things like the Earned Income Tax Credit, food stamps or SNAP, Pell Grants, TANF, the welfare program. We see less than 80% or lower take-up rates in a wide variety of programs, and we want to understand why and how to interpret it as economists. So I think when you ask how do we expand take-up, what would be the policy route forward? There are sort of two approaches you might think of. One is the standard approach, which is to apply financial incentives, make insurance more affordable, more generous subsidies, perhaps penalties to be uninsured, but that's proved politically unviable. That's the central approach of the Affordable Care Act, financial incentives. And we know those work. There's a lot of evidence that those work, but we also have a sense that maybe there's a limit to them. We still have about 30 million people uninsured, despite pretty generous financial incentives in the ACA. So in this paper, we want to think about an alternate approach that we think needs more attention by researchers, which is just making the process for enrolling in health insurance simpler, or maybe even automatic. Making it easier to enroll in insurance. And the premise here is that if you look at the US health insurance system, especially compared to, say, other countries, there's a lot of hassles to enroll in health insurance. It's not automatic. Or to put it in the helpful term that Don Moynihan and Pamela Hurd have come up with, there's a lot of administrative burden to enroll in health insurance. It's not automatic. You have to do work to get covered. What if instead it were much easier or even automatic to enroll in coverage? What would that world look like? How should we think about the trade-offs involved with that? That would be the first question that we try to address in this paper is how important are hassle barriers, non-price ordeals, as a barrier to enrolling in health insurance, and how should we think about their implications for coverage and take-up? There's also a second motivation of this paper. So if that's the policy motivation, how important are hassles on insurance? The second motivation is in a deeper economic question around what's called the economics of ordeals debate. Okay, so for those who aren't familiar with that, let me introduce that idea to you. Economists for a long time have noticed that it's not often easy to enroll in social programs, and they've asked, is that optimal? Is it optimal to make it easy or hard to enroll in something like health insurance or TANF or food stamps? And there's been a debate about this. There's a classic contribution by my colleague Richard Zeckhauser at the Kennedy School with Austin Nichols, 1982, arguing that in some cases ordeals might be beneficial. It might be good to make it hard to enroll in social programs because it can help target our limited resources in the government to those who most need the benefits. And there's an empirical debate about whether that's true, but here's the basic question that's always been asked in the literature. The question has been asked, okay, we think ordeals will work well if they serve as some type of, you can think of like a non-financial price to enrolling in a program, right? So in a market, you pay a price to get a good, and those who most value the good are the ones who pay the price. And so you get this kind of, what you might call self-screening, right? In markets, those who are willing to pay the full amount, and they are the ones who screen into buying the good. Those who aren't willing to pay, who have value less than cost or price, screen out. Do ordeals work the same way as that, right? Do we see that a hassle to enrolling in programs screen out people who don't obtain much value from the program, who don't benefit much, maybe don't need it in some sense, or do they screen out those who do need it, right? That's been the classic question that's been asked and debated in a long empirical literature. And the question is basically, does revealed preferences work? Are we getting the screening that we would hope with markets? What we want to argue in this paper is that while that's been the classic question that's been asked again and again in the empirical literature, it's missing something important. In particular, it's missing the role of varying costs, right? So think about health insurance. It's health insurance, right? It's the same product, but it costs vastly different amounts for me, a healthy person, versus my neighbor who's a sick person. We cost vastly different. They might cost 10 or 20 times as much as me as a healthy person. And that's really the fundamental feature of what economists call selection markets. They're markets where cost varies widely across different enrollees or consumers, and costs may also highly correlate with people's demand for the product. And in selection markets, some of the classic economic ideas around screening and targeting may not work the same way. And so in this paper, we want to ask, does the ordeals targeting logic work well in the context of an adverse selection market like health insurance? Okay, so what do we, yeah, Chris.
Question. I mean, when we think of work well, does it kind of matter what our perspective is? So if I'm a social planner, maybe I actually want lots of advantageous selection in terms of those people who need insurance more presumably, and so that's kind of like the social planner versus if I'm a insurer, maybe I actually want more adverse or advantageous selection rather to get healthier people in and save my costs and actually select sick insurance.
Definitely. So this is a normative economics. And so I'll frame it in terms of a social welfare function, like a government who's trying to maximize social welfare subject to fiscal constraints. But you can think about different players having different objectives, and totally that would change how you think about this. Yeah. Okay, so let me give a brief overview of what we do in the paper, and then I'll pause for questions. We're going to do basically a couple things. So first, we're going to provide new empirical evidence on this question of whether hassles matter. To do that, we're going to study an hassle reducing, or you can think of it, ordeals reducing auto-enrollment policy that was used in the state of Massachusetts in our pre-Obamacare health insurance exchange. So how did this policy work? This policy removed a step in the enrollment process, which was a step of needing to actively choose a health plan once you've qualified for subsidized health insurance. And so when people qualify and they're pinged and asked to choose a health plan, if they don't choose, they don't respond. They're passive in a sense. This policy will auto-assign them or auto-enroll them in a plan so that they by default get coverage as opposed to by default not getting enrolled. We'll have variation in this policy where it's enacted, it's occurring in the first few years of the market up to 2009, and then it gets canceled in 2010. And so we'll use that policy variation to give you causal evidence on the impact of this policy on take-up and other other outcomes. We'll do two things with that variation. We'll first give you empirical descriptive causal evidence. And what we'll find is that this minor hassle, adding one more step of needing to actively choose health insurance, will have a major impact on a couple things. First, it'll have a major impact on take-up. We'll find it reduces take-up by about a third, which is a huge impact. We'll show how that compares to other interventions, but it really is quite a large impact compared to prices or other things that we've studied. And it matters for targeting. It differentially will exclude kind of the people you'd expect, the people who are young, people who are healthy, those who have lower costs, those who in some sense maybe need health insurance less in an absolute sense. Also tends to exclude more economically disadvantaged folks and folks from disadvantaged neighborhoods and high minority neighborhoods. So it also looks like it's kind of harming the equity of health insurance take-up, and that's also important to keep in mind. What we'll then do with this empirical evidence is plug it into a model, and we'll try to show you how you should think about adverse ordeals targeting, that classic self-screening logic, in the context of a market with a lot of adverse selection like health insurance. And we're going to argue that adverse selection tends to undermine the classic ordeals logic. We'll walk you through the logic of that. And basically, the idea will be that those low value types who ordeals were supposed to screen out in a market with adverse selection is all about the idea that low demand people also have low cost. And conversely, high demand people have high costs. So if you're using a non-price tool to screen out low demand types, you're not necessarily screening out inefficient types in terms of value or demand relative cost. And so this whole logic we're going to argue it just kind of doesn't work. You don't really want to do a lot of ordeals targeting in selection markets. Instead, you probably want to think about universal policies, trying to make it better to just enroll everyone. Or if you're fundamentally opposed to health insurance under certain welfare functions, you could say enroll no one. But the targeting goal of ordeals just doesn't work well. We'll show you formally how adverse selection kind of taxes away the gains from targeting that make ordeals work. Okay, so that's where we're going in the paper. Let me pause and see if there are any questions before I dive into the meat of the paper.
Mark, just in terms of the framing here, so if I think of people having opportunity costs of time, the distinction between price and non-price cost of enrolling kind of becomes less important. I mean, isn't this just kind of the classic adverse selection story, just recasting the price of enrolling in terms of these opportunity cost type of things? Or is there something deeper that makes the non-price aspect of this kind of special? Does that question make sense? I'm not sure if it does.
It does. Thanks, Peter. So actually, let me get to your question this way. So you might have thought this was different than classic financial prices. So the classic Nichols and Zeckhauser case for ordeals is that hassle prices will work differently than financial prices. And they might more effectively screen out people who don't really need a social program or have low value from a program. And so you might have thought that they would work differently. Actually, our evidence is consistent with the hassle price working very similar to a financial price. And so what you end up coming to is an idea that actually it's just the standard idea that adverse selection leads to imperfect or maybe even unproductive targeting in health insurance with financial prices translates 1-for-1 to ordeals. Does that kind of get at what you're asking?
Yeah, that's helpful. Thanks.
So you might have thought they were different, but actually it looks like the ordeals kind of screen similarly. And just like financial prices of insurance, we think may not be desirable, right? Choice and prices often screen imperfectly in health insurance or other insurance markets. We're going to find the same thing here. I think that's the core of our results. Great. Yes.
Quick question here. So your setup of the ordeals problem right now seems to rest on kind of a rational utility maximizing for individuals and with kind of these costs, these non-price cost paying for people deciding on that basis. But it also you're previewing an alternative model behavior that seems like it's not entirely rational. You're going to give that a more detailed treatment about people who rationally perhaps do not understand that, or nothing said perhaps from a behavioral economics perspective?
Yeah, no, to be clear, we're gonna argue that the main explanation for why hassles matter so much is behavioral frictions. Lack of information, lack of understanding. So we're gonna very much be in the behavioral camp for this paper. What's interesting though is that behavioral frictions can target properly, right? If everyone experiences the same behavioral bias, it's like a homogeneous bias, you can still have proper targeting in a Nichols and Zeckhaus or Ordeal sense. We're gonna find though that doesn't work. So even though we'll be behavioral, we'll be in this behavioral public econ debate about when do behavioral biases make things better. We're gonna find actually it doesn't make it better here. Yeah, Ben.
So this all makes sense to me, but we also have tools to deal with adverse selection, like subsidies, which are kind of what you mentioned in the first motivation slide. Have you thought about combining subsidies with reducing hassles to kind of undo some of the problems that you're describing?
Totally. So I think we're on the same page. If the classic problem in financial financial prices of health insurance or insurance is it's too high because of adverse selection, you should subsidize it. We're kind of arguing the same thing with hassles. The hassle prices also lead to inappropriately bad screening, so you should subsidize them down to make enrolling automatic. Maybe even make it easier to enroll than the sort of real cost. If there's some real hassle cost that has to be there, you'd want to make that as low as possible. That's going to be the takeaway of what we find in our empirical model. Yeah. Okay, so let me skip the related literature slide, but we're related to stuff on health insurance coverage to take up nudges and this Ordeals debate. Okay, so outline of where I'd like to go in the remaining time we have. There's two parts of the talk. The first 2 points, setting and policy variation, and the descriptive results are the core sort of reduced form work. And we can spend as much time as we want there. I know that this is probably an audience that will have a mixed different background, so that will hopefully be more transparent, and I'm happy to take as much time as we need on those. Then sections 3 and 4, the theory and empirical welfare analysis, will be deep in that public economics part of the motivation. And whatever residual time, I'm happy to nerd out there for the folks who are into these arguments. There's some fun graphs that I want to make sure I at least show a little bit of in that part, but in terms of theory. But I'm willing to. We'll probably spend most of the time on points 1 and 2, and then after we're done with those, I'll conclude. Okay, let me give you the setting and show you what I'm talking about in terms of the reduced form and the descriptive evidence. Okay, so before I dive into the specific setting we studied, let me tell you about the broader context that I want you to have in the back of your head. So I want you to think about the US health insurance system as being not a single organized system, but like a patchwork of multiple systems all sitting alongside each other, right? So it's a fragmented system, in other words. So when you are someone who's below the age of 65, there's really not just one main source of health insurance. There's 3 main sources of health insurance. There's job-based health insurance if you have a job. There's Medicare and Medicaid, although most of that is Medicaid for under 65. And then there's everyone else who doesn't fit into one of those 2 categories, and they're going to be eligible for individual private health insurance, including via the Affordable Care Act health insurance markets or exchanges. Okay, so in order to get health insurance in America, you have to find your way into the right bucket and enroll in what you need. And one of the challenges here is that eligibility in the buckets isn't static. So if everyone stayed in one bucket for their whole life, we could just enroll you in your bucket and you could just stay put. But actually, in practice, eligibility changes a lot. So if you lose your job, you might lose job-based health insurance and need to enroll in either Medicaid or an exchange. If you're on Medicaid and your income goes up, you might lose Medicaid and you need to enroll in an exchange. If you're an exchange and you get a job that has job-based coverage, you might need to leave that and enroll in your job-based coverage. So what you have is a system where there's a bunch of cracks. People are constantly being handed off or transitioning eligibility, and they need to find their way to actively enroll. And it's easy to fall through the cracks because at every stage, the default outcome, if you just do nothing, if you just sit on your butt, which I'm very good at, many Americans seem to be very good at, the default is to become uninsured. And so I think that's the broader context you want to have in mind, is that we're speaking to this issue that is endemic in this fragmented system. you have to do work to enroll in coverage at various intervals of time. And if you don't do work, the default is you become uninsured. So with that context, what we're going to study is one crack in the system, which will be the enrollment in the health insurance exchange part of the market. And we're going to look particularly at the Massachusetts Health Insurance Exchange prior to the ACA. This was a market that you can think of it like pretty much like the Obamacare things, although it went down the income scale a little bit further than Obamacare. It's a subsidized health insurance exchange for people, low-income adults below 3 times the poverty line who are not eligible for other insurance from Medicare, Medicaid, employer health insurance, or military or anything else. So basically, the group of people eligible for this program are folks who don't have another form of coverage. They're either going to take up insurance through this program called Commonwealth Care, or they're going to become uninsured. And we verify that that's basically true using some data where we can see both. The setup in this market, it's you have to enroll and choose a plan. The plan choices are really pretty simple. This is not Medicare Advantage. There aren't 50 choices per enrollee. There's 4 to 5 insurers participating. Each one offers a single plan that has standardized cost sharing. The networks of doctors and hospitals covered do vary. So, there's something at stake of what plan you choose, but it's not like a high stake decision to choose plan A versus B. It is high stakes potentially, though, to choose to enroll and get insurance versus become uninsured. We're going to look at this auto-enrollment policy that I'll lay out how it works on the next slide, but just as a preview, this applies only to the lowest income group in the market, those who had incomes below the poverty line and therefore qualified for free coverage. So there's not the auto-enroll policy kind of worked because you didn't have a financial premium to pay. And so it was, in some sense, policymakers weren't worried about auto-enrolling in people in something where they'd rack up financial bills. Here the premium was 0. And what it did is it assigned plans to people who were approved for coverage, but who don't actively choose plans within a 2-week period after being approved. It's based on a similar policy that's been used in Medicaid just as a standard thing. And in fact, about 40% of people nationwide appear to be enrolled in Medicaid via this kind of default auto assignment pathway. That policy, though, is not used in the ACA today in Obamacare insurance exchanges. So this is something where, different parts of the system are doing different things. What we'll see in this setting is the same system, ComCare, Massachusetts Exchange, doing different things at different times that lets us get causal evidence. Okay, so how does this work? Let me just lay out, so if you're confused, how the enrollment process works and where the default or auto-enrollment policy fits in. So say you need health insurance. You've just lost your job, you've turned off Medicaid, so maybe your income's gone up, but you're no longer Medicaid eligible. There's 2 steps to enrolling. Step 1 is to apply for eligibility. There's an eligibility application. It's the standard, your good old friendly government form, 6 pages of regular forms where you fill out your income, your family size, et cetera. And then there's an appendix if you don't fall into the normal category. So it's your normal bureaucracy, fine. People often get help. Anecdotally, we've talked to people in the field. A lot of people get help from medical staffers or social workers to do these forms, but everyone in our study will have already filled out a form like this. Then if you're approved, right, if you're rejected, you're not in our study, but if you're approved and you're eligible, there's a second step to enroll, and that's choosing a health plan, right? This is a market-based system. There's multiple competing health plans. Consumers need to choose. And so what happens is you're mailed or also emailed if they have an approval letter, and you're asked to either go online, call them on the phone, or even just circle the plan you want on the paper form and mail it back to them. And again, the folks we're going to focus on, it's free. So this last step is the key thing we're going to be asking about is you have to do some small action, a small hassle, a small step to enroll in coverage. And then what happens, right? So if you do actively follow that step and you choose a plan, you're enrolled in insurance. That's always true for the whole study sample. That's true today in Obamacare. But what about if you don't respond, right? This is the sort of thing that the bureaucratic policy designer didn't anticipate, right? They set up a system to help people get coverage, and then a bunch of people didn't follow the rules. What do? It turns out this is 1/3 of people in our sample. Right? This is not a small group of people. This is 1/3 of individuals. And that's where policymakers have a choice. This is the key insight of the administrative burden framing. they can do two different things. They can either not auto-enroll, which is what, Obamacare is doing today. And then by default, you're going to slide into not being enrolled. You're going to be uninsured, right? You could call back later and try to take it up, but at least for a period of time, you'll be uninsured. Or we can say, look, we know you're eligible. You've already done step one. Let's eliminate step two and make it easier to enroll. If you're auto-enrolled, we'll just assign you a plan. And then you can switch ex post, but you're by default covered. We're going to study the causal effect of either auto-enrolling versus not auto-enrolling, which is, you can also think of the causal effect of adding a little hassle to enroll in coverage. So we'll have this policy variation. The auto-enrollment policy is in place for the below poverty enrollees, 0 to 100% of poverty until the end of 2009 in the market. We'll compare them to a control group of people, 100 to 200% of poverty, who don't have auto-enrollment, apply to them throughout. We'll then see a natural experiment. The end of auto-enrollment suspended at the start of 2010. That will give us one shock. We'll also see a temporary reinstatement of auto-enrollment in the last 3 months of 2010. So this will give us our setup for a natural difference in difference design to estimate the causal effect of the hassle. Okay, so what we'll do is we'll leverage a data set, an administrative data set that has full enrollment and insurance claims linked at the individual level for everyone in this market. That will let us see new enrollees. We're going to focus on new enrollees because that's where the rules are most straightforward. And we'll then see their subsequent enrollment spell. We'll see whether they were auto-enrolled or not, right? Whether they're actively or passively enrolled. And the one limitation I want to point out is we don't see data on the people who are eligible but don't finish the process and enroll. That's standard in studies of administrative programs, is you often don't see the people who could have gotten enrolled but didn't. We'll see them in the period where they're auto-enrolled in the pre-period, but we won't see them in the post-period when they're not enrolled. We'll then do two analyses. We'll look at the causal impact on enrollment, and the second analysis, who are those marginal enrollees due to auto-enrollment. We'll try to infer that from the data. Okay, let me pause and see if there are any questions on the setup before I go on to results. Yeah, Chris.
Would we potentially worry that the people who become newly enrolled at, say, like the end of the year in, I guess, 2009 versus the midpoint of the year in 2010 might be eligible for different reasons, or job loss or seasonal hiring, that type of stuff?
Yeah, well, that will be where our control group will help. We'll have people who are just slightly higher income, and if they're economic shocks, I'll show you there's some wiggles in the data, and the control group sort of helps net out those wiggles. We think that's mostly due to the Great Recession.
Okay.
And then the control group helps net those out.
And then just kind of like institutionally, what was the reason for the reinstation of the auto-enrollment?
Yeah, it's funny. So in the initial period, they had auto-enrollment in place because it was like they were copying Medicaid. This is a Medicaid-like program. It's actually implemented under a Medicaid waiver. And then they ran out of money. So they cut auto-enrollment in 2010 because they ran out of money. And they either had a choice, they either raise premiums or cut off, auto-enrollment was the easy, got on the chopping block. But then it turned out it was so effective that they had a little extra money here. And they brought it back for 3 months. But then it turned out that they decided, okay, well, we know we can't do this policy under the ACA, which had just passed kind of in this period in 2010. So they didn't bring it back in 2011 because they were worried. They wanted to create continuity for what they knew was coming down the pike. Yeah. Like I said, I can nerd out about the policy details all day. Yes, please.
So the auto-enrollment portion was the second step where, people know that they're eligible and then they have to circle their plan choice. But what about those people who don't even have the interest to check whether they're eligible or not? What about the administrative burden on that end?
Totally. No, we're studying, like, you can think of there being some spectrum of amounts of administrative burden. We're going to study a marginal decrease in administrative burden, or I guess it's the marginal increase in administrative burden. We're going to show you there's big effects. What I think you should take away is that if you extrapolate that, there might be even bigger effects if we completely auto-enrolled everyone in the population. Right? There's challenges to doing that, to be clear, but we want you to take away that the hassles matter a lot, and this is just one piece of the hassle puzzle. Yes, please.
I know you said something about behavioral economics, but this setup reminds me a lot of the sort of default option, right? With the pension plan, you just sign up, they put you in 401k, and you're whatever, 30, 40 years later, you don't have to think about it and how much more take out. Or in HIV testing, to the opt out, you go to the emergency room and it opt out because you had some sort of emergency and because you took some risk, maybe you take also sexual risks, and you can see that the HIV prevalence is so much higher in the ER rooms. It's because of the opt out, there's more people. So it seems like it fits very well in the behavioral econ framework, but maybe you're doing that later, but
Yeah, it's a great point. I really appreciate that comment because we've had different iterations of how we frame the paper. Is this an auto enrollment paper? Is this an Ordeals paper? Is this a health insurance coverage paper? We've come around to kind of all three. And when you write down the theory as we did and start working it through, the three theories kind of start blending together, right? They intersect in an interesting way. So I think we've situated this more in the Ordeals literature, but the fact that like this little ordeal has such a big impact, you can interpret through a behavioral economics lens in the same way that like auto enrollment pensions had a big impact and so forth. So I think we're on the same page. Yeah, definitely.
Implicitly from this graph, I'm like thinking this ordeal is a bad thing. It seems like what happened is a bunch of people come off of plan and then the state doesn't have to spend money on utilization. So that means that people stop going to see the doctor, right? If they
That's right.
now suddenly have money again, right? So implicitly a bunch of people stop going to the doctor.
Yep.
That seems like a pretty bad thing.
So this goes back to what's the goal here, right? So if in the kind of the normal, the health policy framing of the goal is we want to maximize coverage. We want to get everyone enrolled. If that's the case, then this was bad policy, right? It was just adding sludge to the system. And I'll show you it had a big impact on people losing coverage. There's a other lens, which is the public economics lens, which is to say we want to maximize good outcomes, welfare, subject to a fiscal budget constraint, which is exactly why the state cut this. They were subject to that fiscal budget constraint. And there it's not as clear, right? We definitely get people off coverage, which is not good, but we also save money. And what's the trade-off between the two? That will be what our model in the second half of the talk will look at. If we could?
No, we're good.
Yeah, but I'm with you. I mean, I think I've written New England Journal perspective and other things saying we need to reduce ordeals within the system. I'm gonna get there though. I'm gonna get there by taking seriously the economics argument for why you might want to have ordeals and then reject it.
It's just the fact that they came up with the money that they had money again is what was very interesting. That's all. All right.
Okay, so we've gone on this. So let me walk you through. I'll spend about 10-15 minutes on results, descriptive results. Let's start with enrollment. This is a graph where you can see basically everything in the study. So if you need to go out after this, you can probably get most of it from this. I'm showing raw counts and the raw data of new enrollees per month. So these are the flow of new enrollees into the system over time on the x-axis. And we have in blue the number of people who actively enroll, who actively choose. In red, the total. And you can see there's the gap between these is the number of passive enrollees or auto enrollees. That's about a third of people pretty stably in the pre-period that we're looking at. And then in 2010, the policy is canceled. And you can see a sharp fall in the number of people who are enrolled total, no auto enrollees, and no evidence of an uptick in active enrollees. So it doesn't look like some people were just not enrolling because they knew the state would auto enroll them. It looks like this share of people who were being passively enrolled kind of disappear. Then in the period where the policy is temporarily reinstated, they come back. We don't have data on the active enrollees distinction in that period. And then when the period that goes away, we're back to the steady state of lower enrollment. Okay, so this tells you that looks like there's a causal effect of the policy, and it seems to mostly be just about whether these passive types of individuals are enrolling or not enrolling. This is a difference to difference regression that then, takes seriously econometrically having a control group and trying to net out any trends and things like that. And you can see that it looks quite good. So comparing the treatment group in red to the control group in blue, this is again the flow of new enrollees per month, where one is the normalization of the average enrollment for both groups in the pre-period. And you can see that they're very parallel and almost on top of each other in the pre-period. Then when auto-enrollment suspended at the start of 2010, there's a sharp fall in the flow of new enrollees for the below poverty, not much change for the above poverty. We estimate a difference effect of around 33% reduction. That's spot on to what the share of people who are being auto-enrolled passively in the pre-period was. We can then look at the change in the number of active enrollees, and we find no impact. So what you can take away from this is that basically auto-enrollment didn't seem to be crowding out active choice. It seems to just be about affecting whether a set of people who, for whatever reason, are passive do get enrolled or don't. And there's not a lot of like strategic passivity where you say, well, I know that the policy will auto-enroll me, so I can just not work. No, it mostly looks like people are just being kind of exogenously passive, or they're not being so strategic here. We, by the way, verify that by looking at changes in average characteristics of the active population. We also see no impact. So it doesn't look like there's some shift here. It really looks like the passive folks are almost like a exogenous state that people are experiencing. Okay, so summarizing the effects on enrollment, we're finding that this modest hassle leads to a major reduction in enrollment, 33% lower new enrollment, 24% lower steady state enrollment when we do the calculations there. In the other direction, you can think about moving from no auto enrollment to having auto enrollment, like increasing take up by about 50%. The most likely mechanism seems to be behavioral, inattention, and misunderstanding. If we had more time, or probably offline, we could dive into some evidence we look at to point out why that's likely the case. We see some evidence that is more likely to be true for people facing bigger behavioral frictions, like language barriers, individuals who are lower income and may have more, struggles understanding the system, as well as people where there's some sign that perhaps there's an address mismatch where they might not have gotten it possible they didn't even receive the enrollment paperwork. So a bunch of frictions where people may not know that they need to take this extra step to enroll. It's not like that step is massively costly. It's like a lot of people may not understand that they need to do the action, and therefore they fall through the cracks. Second thing we want to point out here is that the magnitude's really big. It's a really large impact relative to other take-up policies. So again, think about auto-enrollment increasing take-up by around 50%, going from none to having auto-enrollment increasing take-up by around 50%. That's an order of magnitude bigger than what we've seen from smaller nudges, things like sending out outreach or reminder emails or letters. Those tend to increase take-up by around 1 to 4 percentage points. This is a third to 50% effect, 10 times as big. It's also bigger than the mandate penalty, which we have good evidence on in Massachusetts. It's about 1.25 to twice as big as the impact of the mandate penalty on enrollment. And it's comparable to the impact of cutting premiums by around 60%. I've done some other work on this in the same market, and it looks like the sort of equivalent financial subsidy is around $470 a year. So again, this is where the behavioral economics comes in. You might have thought it's just circling a number. It's just calling a phone line. It shouldn't matter that much. Maybe it matters a little, not that much. We're showing here that it has an equivalent impact in terms of number of people taking it up as a $470 a year premium. So that's where you think, okay, there's something behavioral here where doing the work, perhaps because of knowledge barriers or other things, is sort of having a magnified impact. And we're going to find actually the targeting impact of premiums versus auto enrollment is also pretty similar. It's just extra barriers to getting coverage that seem to have a big impact. And so if you're unhappy about that, if you want universal coverage, the answer is get rid of the barriers. Right, so that's our takeaway. If you're happy about non-universal coverage, this is the other side. So if you want people to be uninsured, this gives a lot of power to policymakers to put sludge in the system that can have first order impacts on who actually gets coverage. That's the good news and the bad news of our paper. And how policy plays this out, I think will be interesting to see. Yes.
Do you have any sense of what utilization of the health insurance actually looks like when somebody's enrolled? If they're
Yeah.
actually like using. Yeah.
Let me do that just next. Yeah. Any other questions?
Mark, you may have said this, but just to clarify, you're just using the first policy change for all these estimates, not the temporary reinstatement, or?
Correct, although if we put that in, we do a robustness where you put it both in and it's the same. There's no difference.
Got it. Thanks.
Question, but feel free to defer if there's a better time to touch upon this. I'm thinking about your finding here and the current health insurance landscape where you see a lot of states experimenting with public option plans and so on.
Yeah.
And so I'm wondering, on the one hand, auto enrollment is great because you make sure fewer people slip through the cracks, but there's some evidence to show that in situations where you have states innovating with, say, cheaper insurance products, auto enrollment in the status quo might actually prevent uptake of those innovative, cheaper public option
Yeah.
plans. So I don't know if there's a right time to touch upon that, but I'd be interested in your thoughts on, like, what can we learn from this in the sort of current policy landscape around as stated?
Yeah, it's a great question. This paper is kind of narrowly focused on the, do you get health insurance? We have not thought hard in this paper about what that insurance is among the choices in the market or what the strategic competition impacts are. Actually, we do hope to go there next in the next paper, but you should think of this paper as being kind of agnostic about what insurance you're getting and just asking, do you get insurance or are you remaining out of the market?
The cost to the patient is zero, but
Yeah.
somebody's losing it.
Yeah, it's borne by the state. I mean, it's basically, you think of this as basically like Medicaid insurance. It's free, there's very low copays. It's the state. Okay, let me do 5 minutes of targeting, and then I do want to at least show you a little bit of the model, although I think that will have to take second fiddle. So who gets enrolled by this policy? This is just a table that shows for the actual active and actual passive enrollees in the pre-period, what did they look like? And again, it looked like the passive enrollees in the pre-period were the same as the marginal enrollees. There's evidence of that at least. So I think this is indicative, but we'll also do a robustness using the policy of change itself to infer marginal. Let's start with this because it's more transparent. If we compare for various characteristics, active enrollees characteristics versus passives, again, we can see both in the data in the pre-2010 period. What we see is that passive enrollees, that marginal group, are younger and healthier. They're about 4 years younger, 20% less likely to have a chronic illness, about 36% lower risk score, which is a way of predicting their costs based on their diagnoses and age. We also see their lower medical costs, about 44% lower medical spending. Again, that's mostly consistent with them being younger and healthier. It doesn't look like there's some magic here. It looks like it's mostly just predictably lower costs because they're younger and healthier. And then finally, the passive enrollees are also a little lower income and lower SES, more likely to live in high minority neighborhoods, more likely to live in disadvantaged areas. So those differences aren't huge, but they are relevant, right? We're sort of discouraging enrollment among a group who we might particularly care about from a social welfare or equity standpoint. Here's a graph that shows that just in graph form, that table in graph form. I'm plotting kind of the reverse conditional probability, which is not the means conditional on active versus passive, but the rate of passivity by characteristics. So this is by age. And you can see that the most likely to be passive, so this is the passive rate, are young men. They're almost 50% or over 50% likely to be passive. That's interesting because that group is particularly, there's been some recent work showing that when young men lose health insurance, particularly if they have mental health challenges, there's more crime and criminal justice costs. Elisa Giacomi has done some really cool work on that. So I think it's a very policy relevant group, but they are the most likely to be passive. And it declines monotonically with age for the most part. But even among this older group in their 50s and young 60s, about 20% are likely to be passive. So it looks like there's sort of, lack of attention or information among everyone, but it's larger among the young and healthy, but it's there for everyone. Similarly, if we look at health risk, so now we've plotted risk score on the x-axis, where 1 is just like the average in the population. That's a normalization. And then you're plotting medical risk compared to that. Again, it's highest, passivity is highest for the healthy people. Low risk score, it gets up to around 50%, but it's still there even for people who are very sick. 4 or 5 times sicker than average.
Quick question. I wonder how much of this is because of like social workers and others within the hospital system or the healthcare system saying, you're here a lot. Let's make sure you get enrolled and I don't have to worry so much about bad debt or whatnot.
I think it's probably related in the sense that more of these guys are being contacted and helped by social workers when they go to the doctor to enroll, and they're reminded to make sure that they call back and choose health insurance, whereas fewer of the young and healthy people are. I think that's probably a part of the mechanism here. We don't have direct evidence of that, but it's plausible. We also can do robustness to infer who the marginal group are using the policy change itself. This is a graph that shows the average medical spend, the average cost of people who are all enrollees, passive and active, in the pre-period for the treatment versus control group. You can see it jumps up for the treatment group, right? The policy that's consistent with the relatively low-cost people being selected out of the sample. So the jump is actually a selection effect. And when you do the line of algebra that you need to infer who the marginals are, you find that the marginal enrollees are about 43% less expensive. That's spot on with just the active versus passive comparison. So we think that's working well. Okay, summary. Passive enrollees are younger and healthier, lower SES, but passive enrollees also have much lower costs. Okay, so consistent with self-screening, the classic Nichols and Zeckhauser idea, but also consistent with adverse selection. And so in the last part of the paper, what we want to ask is, how should you think about that? What's the public economics understanding of whether ordeals work well in a social welfare sense for health insurance markets, given that we do see some evidence of self-screening, that people who sort of value health insurance less are those screened out, but we also see evidence of adverse selection. What's the net? How should you think about that? So that's where we'll go next. Okay, so let me push there and show you at least a little bit of theory, and hopefully we can have a couple minutes at the end for questions. Okay, so I think in the interest of time, let me not set up the model. I'll refer you to the paper, but for the details of how it works, but I'll show you in a graph. But intuitively, what you should think is going on is that we're trying to say, when does an ordeal improve the targeting of a program, in the sense of there's heterogeneity in social value of insurance, which includes both private value and any externalities. And there's also heterogeneity in the government cost of health insurance, which includes both direct medical costs as well as any fiscal externalities from the fact that when someone's insured as opposed to uninsured, you're saving on things like uncompensated care by public hospitals. Those two will result in a net welfare gamma, which is sort of the net value minus cost for different groups. Our goal will be that we want to maximize gamma. We want to get more people with high gamma positive enrolled, and we want to screen out negative gamma folks. That's the underlying idea here. Okay, let me skip that. So the idea is that if we target well, we will achieve that goal. So if ordeals screen out people with low value minus cost, or gamma, net welfare, and screen in people with high gamma, high value minus cost, net welfare, we'll be happy. We will achieve targeting gains, and we'll have a positive conclusion. If that's not true, then we'll be unhappy. We will not think that there are gains from ordeals targeting. Okay, so let me set up a graphical model that can help you see why this ordeals logic doesn't work well in health insurance. So it's going to be a pretty simple supply and demand style model that visualizes the welfare gains from targeting that happen here. It's following this approach that some of you may be familiar with from Anov and Finkelstein, or Anov, Finkelstein, Cullen, 2010, that plots the supply and demand for health insurance or other insurance on a standard supply and demand graph, and lets you infer welfare and policy impacts on that graph. So I love this framework, and we're applying this framework to ordeals, which you didn't know it could go there, but we're going to show you that it will go there. Imagine what we're going to do is think about scaling up the strength of an ordeal. So imagine like if you had no ordeal and everyone were just automatically enrolled, 100% of people would enroll on the far right of the graph. As you strengthen the ordeal, fewer and fewer people will enroll down to 0. And then we're going to plot that against values and costs on the y-axis. Okay, so say we have a particular ordeal that screens in PA, share of people, and screens out 1 minus PA. That's going to be our particular one we look at. Okay, people to the left of that threshold are enrolled, people to the right are excluded. Okay, so now let's think about value. I'll bring costs in a second. Let's start with value. Value, if sorting is favorable on value, if there is this self-screening, right, or deals work like a price, then value will slope down. Marginal value curve will slope down, just like we think demand curves often slope down. What that means is, so that's favorable sorting on value. What that means is the people who are enrolled, the average value is higher for those enrolled, V bar A, compared to those excluded, V bar not. There's favorable screening on value. Okay, that's consistent with the self-screening hypothesis. That's the logic of Nichols and Stackhauser. Now that didn't have to happen. We could have, because of behavioral frictions, and this is what's been argued sometimes in literature, unfavorable screening on value, right? If the high value types face bigger barriers because they're poor and they don't have more difficulty navigating the complex system, you could get unfavorable screening. That's not what we saw in the empirical data, but that would be how you would map that onto the screen. Okay, but let's go back to favorable screening. How does value sorting relate to welfare? So it actually depends on cost too, right? That's our key point in the paper, is that the literature is focused mostly on value sorting, but you also need to think about cost sorting to get the full picture. It's not like a groundbreaking point. It's just, it comes straight out of the framework, and it's important, but we think it's been missed a lot in the literature. So we want to consider two cases for costs. Case one is no selection, a standard market, quote unquote, right? So costs will be uncorrelated, constant or uncorrelated with value. The second is adverse selection, which is what we think is happening in health insurance, where value and cost will also be positively correlated. Okay, start with no selection. That's our standard case. In that case, the marginal cost curve is flat, right? The simplest case is think about a program like slots in a public pre-K program. The cost is kind of the same for all kids, right? And maybe a little difference here, a little difference there, but mostly the cost is the same for all kids. And so we can think about the marginal cost curve being pretty flat. And therefore, the gains from targeting, we can visualize as these areas between, demand and supply, or value and cost, where the gains from including, this is an ordeal that I said optimally, right? So I kind of set it up that way. You could have had it non-optimally. It's easier to see in this case. But here, the gains from targeting are the positive area for gains from including the right folks, and the gains from excluding the folks for whom value is less than cost, right? That's the classic setup. And in fact, if you work it out in the paper, it's actually the minimum of those two areas is the social welfare benefit of ordeals relative to the best outside option of either full exclusion or full enrollment. Okay, but now let's think about adverse selection case. And the key thing is, which I can show you with my nifty PowerPoint enrollment animation, is that the marginal cost curve rotates. Okay, that's the key insight of the Anoff-Finkelstein-Cullen model, is that the costs are correlated with value. And so just like value slopes down or demand slopes down, marginal cost also slopes down. And it's pretty obvious to see, because I made it really obvious, that gains from targeting area shrunk. That green area got smaller because there's just less gains from screening, screening out low value types. That's not gaining much surplus. Screening in high value types, that's not gaining much surplus because value and cost tend to align with each other. Okay, that's kind of our point, is that you can think about adverse selection as imposing like a tax that lowers the gains from targeting. We show in the paper this nice math formula in which the amount by which adverse selection, quote unquote, taxes the gains from sorting on value is exactly proportional to this regression coefficient in a projection of cost onto value, beta hat, which is the correlation times the ratio of the standard deviations. Again, more on that in the paper if you're interested. This is the equation we put in the paper, which relates the targeting efficacy on gamma versus value sorting, and it's sort of taxed away by this adverse selection tax. Yeah, got to go on. Okay, and then the other point here is that imagine the cost selection gets stronger, right? So not modest selection, but very strong adverse selection. The cost curve can actually become steeper than the value curve. That's a case that's been highlighted in recent work by Vicky Marone and Adrian Sabetti, a really awesome paper that shows that when the cost curve is steeper than the value, you've actually got what's called backward sorting. When you screen out the low value types, they're actually folks for whom value is greater than cost. When you screen in the high value types, their value might actually be less than cost. And so you've not only not improved welfare, you've actually made welfare worse. Okay, so bottom line here is that you should think of Ordeals logic not working particularly well in health insurance markets because the gains from targeting may be much less, and there's the possibility of completely backward sorting. So that even if you take this view that we're trying to screen on value, it's not actually screening on net social welfare. Okay, so in the interest of time, we've got like 2 minutes left. I'm not going to show the model results, except maybe I'll just show one quick table. But believe me that in the paper, we take the natural experiment to estimate a model of value and cost with some assumptions. We do our best, but we do our best to get use auto-enrollment to estimate enrollee demand or value, externalities, and costs. And there's some assumptions, but we do our best. What we find is basically can be summarized in this table. Comparing the active versus passive enrollees. The active enrollees have higher value of insurance than passive enrollees by about around 30%. But the costs are actually differentially higher for the active versus passive types, about 44% lower cost. So we're actually in the case where, in a sense, based on at least 2 points on those demand and cost curves, the cost curve is steeper than value, and we're actually in the backward sorting case. But I think the broader takeaway you should think of is that really the value cost ratios, which is what this last line shows, are pretty similar for active and passive enrollees. It's not like one group is massively valuable and one group is massively not valuable. It's kind of like if you have a social welfare function, which you think insurance makes sense, you should probably enroll both groups. If you have a social welfare function which you're against insurance, you should probably not enroll either group. There's not a social welfare function. This is actually what we're working on as we revise the paper. We're trying to show there's not really a very coherent social welfare function in which you enroll just the active types and not the passive types. So interesting. That is what happened with lack of auto-enrollment, but we don't find it to be optimal from a public economic standpoint. Okay, we do robustness checks, but let me conclude. So what have I shown you? I've tried to make the case that ordeals are important. You might not have even known that word coming to this talk, but I've taught it to you, and I've argued that they are first order important for take-up of health insurance. Imposing this modest ordeal of an extra step to choose a plan resulted in a third less coverage, enrollment in health insurance, big effect, very large compared to nudges or even financial prices. And so the policy implication is if you want to get to universal coverage, and that's a conditional statement, but if you want to get there, automatic enrollment, reducing hassles should be a first order policy priority. We've also told you the targeting impacts, hassles differentially exclude young, healthy, and low socioeconomic status folks, so it matters for equity. And the general takeaway is that ordeals are unlikely to work well in selected markets because of this value cost correlation. Okay, let me stop there. Thank you so much for your time, and I appreciate it.